Welcome to The Explainer. Okay, imagine this. Thousands of people lose their jobs. A really clear sign the economy's in trouble. But on that exact same day, the stock market, it rallies. That's precisely what went down on December 3rd, 2025, and today we're going to figure out why. So how on earth is that possible, right? How can news that's terrible for the average person actually be good news for Wall Street? It feels completely backward, but there's a very specific logic at play here, and we're going to break it all down. So here's the whole situation in just two numbers. On one side, you have the real economy, which lost 32,000 private sector jobs. That's a clear, painful sign of weakness. But then, on the other side, you have the tech-heavy NASDAQ stock index, which jumped more than 0.5%. This is the central paradox we're going to unravel today. So what caused this totally bizarre reaction? Well, it all came down to one single shocking number about the American labor market. This was the number, a loss of 32,000 private sector jobs, according to the ADP employment report. Now, to give you some perspective, economists were actually expecting a gain of 10,000 jobs. So this wasn't just a small miss, it was a complete 180-degree reversal of what everyone thought was happening. And you gotta understand the context here, because it's crucial. At the time, there was a government shutdown, so the official big jobs report, the one everyone usually waits for, wasn't coming out. That meant this single private report from ADP suddenly became the only piece of information out there. It was the only game in town, which just massively amplified its impact. And the market's reaction? It was instantaneous. Decisive. Traders immediately started betting on an almost 90% probability that the Federal Reserve, the U.S. central bank, would be forced to step in and cut interest rates at its very next meeting. So let's be super clear about what's going on here. This is what Wall Street calls a dovish pivot. Investors weren't celebrating the fact that people were losing their jobs. Of course not. They were celebrating the consequence of those job losses. The near certainty that the Fed would have to step in and make money cheaper by cutting interest rates. And that expectation of lower interest rates, that promise of cheaper money, it just sent this powerful wave of optimism rushing right through the global capital markets. And you could see it pretty much everywhere. Tech stocks jumped. Assets like gold, which don't pay any interest, suddenly look a lot more attractive when rates are about to fall, so it climbed. Even Bitcoin rallied. What's the common thread here? All these things tend to do well when the Fed is expected to cut interest rates, which, by the way, also tends to weaken the US dollar. But if you really want to see just how speculative and kind of wild the mood was, we have to look at one asset in particular, silver. It was pretty much the epicenter of all the day's volatility. Get this. Silver had already doubled in price so far that year. That made 2025 its best year since all the way back in 1979. So you already have this really speculative, high-stakes environment, and this news was just like throwing gasoline on the fire. This incredible rally actually prompted a pretty stark warning from a Bloomberg intelligence analyst, Mike McGlone. He called the move parabolic, which basically means the price chart was going almost straight up. And he pointed out that, historically, these kinds of insane rallies, they never, ever end well. He laid out two completely different paths for silver. You had the bull case, the super optimistic view that silver was going to keep surging all the way to $75, and then you had the bear case, the pessimistic one, which saw a painful collapse all the way back down to $40. It just perfectly captured the day's high-risk, high-reward mood. So while all the financial markets were having this big party based on the promise of cheap money, key parts of the real economy, where people actually live and work, were showing signs of some deep, undeniable distress. The auto industry gave us maybe the clearest signal of pain. The latest survey of car dealers showed they are deeply pessimistic. Just look at that customer traffic number, a score of 31. Anything below 50 is negative, and 31 is a record low. People just weren't showing up to buy cars, and that is a major red flag for the health of the consumer. And this sharp contrast, right? A booming financial market on one side and a struggling big-ticket industry like autos on the other, it points to what economists call a K-shaped economy. And this chart illustrates that trend perfectly. Recent earnings reports showed that deep discount stores like Dollar Tree were doing great. At the same time, high-end luxury stores like Bloomingdale's were also reporting strong sales. This suggests the very top and the very bottom of the economy are doing okay, but the middle, the exact people who might be buying a new car, they're the ones getting squeezed. So on December 3rd, we basically ended up with two completely different stories being told about the U.S. economy at the exact same time. The market story was all about the future. It was about on cheap money, a supportive Fed, and an eventual recovery down the road. But the real economy story was about the present, a painful reality of job losses, struggling consumers, and costs that just wouldn't go down. And that is the core disconnect we saw play out. So what's the ultimate takeaway from all this? Well, we're left with a really critical question. When the financial markets and the real economy are telling two completely different stories, when Wall Street's optimism is literally being built on Main Street's pain, which one of those stories eventually turns out to be right? That's the question December 3rd left all of us asking.